Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, the Director of Investor Education here at PassiveInvesting.com. And today I am joined by Arleen Garza. Welcome, Arleen.
Hi, Whitney. Thank you for having me on the show. It's exciting for me to be on after watching a lot of different episodes. So great to be here.
Excellent. Well, before we dive into Castle Hill Townhomes, 148 units in San Antonio, Texas, tell us a little bit about your background, how you got into multifamily real estate, and where you're at today.
Great. Well, I was originally in Dallas. I was a banker for 20 years, everything from lending to running banking centers to managing a marketing team nationwide. And my husband owned a property management software company. So when he sold it, he convinced me that he had seen a lot of good stuff, the owners that used his software, and that this was a good place for us to start investing our own money.
Oh, fantastic. Yeah. So, I'm a Texas girl. Don't tell anybody from there. But yeah, so I totally understand the big draw to the Dallas Fort Worth area, as well as the San Antonio, San Marcos, that nice triangle down there. Well, let's dive into the details of Castle Hill Townhomes, 148 units in San Antonio. Walk us back to the very beginning. You guys closed this in September of 2022. So last year. How did you find the deal? And when did you find the deal? And how did you find it?
Well, we actually started talking to the broker probably 4 or 5 months beforehand. It was off market. They were basically shopping it to their top 5 buyers in the city. And so we bid on it, but we were not the highest bidder, which is often the case on some of these transactions. But the first buyer, they didn't even make it through contract in terms of their experience. And so the broker came back to us and he said, I've worked with you guys. I know I'm not going to be left in a lurch. You will close this deal. And so we renegotiated the price from what we had originally offered, and were able to get it at a price reduction of almost $2 million. So then the numbers really made a lot of sense. And, the interesting thing about this transaction is that we had just gotten under contract on another property in the same submarket. And so we decided to package it as a portfolio purchase. So our investors were able to make one investment and basically own in 2 properties. And so Castle Hills is one piece of a larger transaction, which was $61 million. And Castle Hills is around $27 million of that total transaction purchase.
Oh, awesome. Okay, that's interesting. I'm sure there's a story here. What kind of talk to us a little bit about the building. What was drew your eye to it? What was the business plan? What is the asset class? What were you when you saw this property, you're like, yeah, it's come back around. We really want to jump on this.
Right. Well, it's a late 90s asset. It is a Class A, an older Class A, but it's in a great submarket, the number 1 submarket for rent growth in all of Texas, which is data we always look at. And so that was attractive to us. But one of the primary things that we love about this property is that it has attached garages. So we've owned other townhome communities with garages, and people just stay. I mean, our renewal rates are 80% on our townhome communities and even higher. So we love that because you're not turning over tenants as often, and it lowers your cost from that standpoint. The other elements that we like about it is it had nice amenities that the previous owner had done a nice job with. A fitness center, which for a smaller community, you sometimes don't get. Also has a really nice pool and grilling area, which we love to offer to our residents. And it's literally walking distance to an elementary school, which is also a key thing we look at. But the seller had done some renovations. They'd kind of done a first pass at renovations. They actually added granite and stainless steel and, did the cabinet fronts, which is typically some of the things we might go in and do. But the only thing that we found from that is they did that work, but didn't capture the rent increases for doing that work. Some of that was because they went through a couple of different management companies, and so they didn't have consistency in their renovation and the way they priced the units after they were renovated. So we are able to come in and do additional units with basically the same package and achieve, we're pro forma a little over $200 rent bumps. And this property is about $350 below market in rents for this product.
Interesting. Okay, so you originally took a look at the property, you submitted an offer, didn't get it.
Right.
A few months later, the property comes back around because the broker, you've already built that relationship. The broker has a relationship with you on previous deals, knows you're going to close. So talk to us a little bit about how you got your sealed the deal. During this, when it was coming back around, were there any other groups taking a look at it? How did you kind of seal the deal on this? What was your offer there?
Well, there was another group that was in that mix of those top 5 buyers in the market, and their price was actually higher than ours by $500,000. But the broker came back to us and said, they're at a higher price. I'm not going to ask you to come up because you are really the best buyer for this. I know you're going to close it, and I can't go through the process again of getting all the way through a contract and then it doesn't go through. The seller has a timeline. They wanted a 1031, the proceeds from the sale. And so all of the pieces came together to make it a really attractive thing for us. And, around that time is when rates and debt and all of that really started to change. So we vetted all of that before we made our final offer with our primary lender. And we actually had a life insurance company provide the debt for this asset. And it's at a great fixed rate, interest only for the full term. And so we felt really good that, again, another piece of the puzzle came into place very nicely.
Oh, very cool. Very cool. Okay. I do want to talk about the debt in detail here in a little bit, but let's stay on kind of the timeline. So you get your offer accepted. At what point in time did you actually walk the property and see all the units? And what did your contract structure look like? Like, how many days did you have to do this due diligence close? And did you have any extensions?
Great question. Yeah, so we did what in the market at the time was a more extended contract and close period. So we did 30 days of due diligence, an additional 30 days kind of for the lender and all of that to happen. And then we built in another 30-day extension in case the lender needed more time, because again, we're in a little bit different market from a lending standpoint. So we wanted to make sure that wasn't going to create an issue for us to close the deal. Being vertically integrated or having in-house management, we literally can go in and out and do due diligence on all the units in no more than 3 days. In that period of time, our capital projects manager brings in all the vendors that will need to give us a bid on some piece of the rehab. And so before we even finish that, we've got all of our bids. We've refined our rehab dollars and know exactly where they're going to be spent. So pretty fast process for us because we do control every bit of it. And it's nice for the seller because we're in and out and we don't disrupt their operations, which is the last thing you want to do when you're going to take it over in a few months.
All right. So you go in, you do the due diligence. What were some surprises that popped up? Or were there any?
There were some from the standpoint of we always do a really solid look at roofs. If you live anywhere in Texas and you're from Texas, so you know different parts of the state have different weather events. And so owning 8 other assets in the market, we knew that there had been a hailstorm that had passed through that particular area a few years back. And so we did our due diligence to find out, was there a claim filed? What did that look like? The roofs were okay. There were no leaks or any of that. But anytime there's hail damage, it reduces the life of the shingles on the roof. And so we went through an extensive process, told the seller, this is the inspection, shared it with them. We always want to be transparent, and said, let's look at what there might be cost from a repair standpoint. So we negotiated some dollars for the roof that the seller agreed after looking at the inspection that needed to be done.
Okay. Okay. Anything else that came up on either the physical due diligence or financial due diligence?
No, not at all. We comb pretty heavily through all of those rent rolls and the 12 months of financials that they provide us. And we didn't run across anything that, caused any concern at all.
Okay. And so just out of curiosity, it sounded like you did do a little bit of retrade over the roof. So what was your offer? And then what was in your purchase was 27 million? Is that correct? Okay. So what was your initial offer?
It was 28 million, 27,750. And then it ended up being 27. So, yeah.
Awesome. A little bit of negotiation went on there.
Yeah, that's always the part that I think you have to go in just very fairly sharing everything and saying, this is a situation. You can either file a claim, which there's no time to do, or, let's negotiate a price and we'll take care of the repairs.
Speaking of claims, just having had experience with Texas properties and, the power grid that went down there, that whole issue. Did this property have any previous claims related to like water damage from that event like a few years ago?
It did not, but that is a question we always ask when we're buying a property. Was there water damage? Was there any damage from the storm? And we also ask for loss runs on their insurance so that we know if they had a claim related to any of those weather events, and they did not.
So I'm going to ask a hypothetical. Okay, I'm going a little off script here. So if you entered a new market and you didn't have previous experience with some of these major storms that have rolled through and probably caused a lot of damage, how would you get at that? How would you begin to understand some of those things that you need to watch out for?
Well, I would make contact with a public adjuster. A public adjuster is somebody that represents an owner when there's a claim on an insurance policy. They will know the history of every storm that ever passed through that area. So I would recommend that you get some recommendations. If you're working with a property management company, they typically will have worked with a public adjuster. And so you can ask for some recommendations from that standpoint. And they will always have all of that history, some really cool maps and awesome stuff that they can show you.
Excellent. Well, thank you for that. All right, so let's get to the capital stack. So you secured the loan with the insurance company. The final purchase price was 27 million. What did you get for lending? How much did the bank come in at? What was the rate specifics and stuff like that? Sure.
The leverage that we got, or the amount that the bank lent out of the whole purchase, was 67%. And they also financed $1.2 million worth of our rehab, which was our total rehab budget. So 100% financing of the rehab, which is nice because then you don't have to raise those dollars. The rate was a fixed 5.28% rate, which we felt good about at the time because that's when rates were really starting that climb. And these lenders will always add a cushion to their rates when they're quoting you fixed to cover any rate increases they anticipate. So 5.28 was, we felt, a good rate. And then Of course, interest only during the life of the term. It is a 3-1-1, which means 3 years initial term and then 2 1-year extension options.
Okay, excellent. Well, and then so how much did you raise for the deal from investors?
Just under $14 million for this deal.
Okay, and then tell me, how did you structure it?
Great. So we had an 80-20 split, which means 80% goes to the limited partners or the investors, and then 20% is retained by the sponsorship group. But an interesting thing we've been doing on our assets is we have 3 classes of investors. They're all important, but some investors want to earn a little more by investing more. So for example, if they invest $1 million, their split is a little better. They would get a 90-10 split, right? 90% of the cash flow and proceeds from a sale going to investors and 10% to the sponsors. So we've found that that is a nice structure. And so there's an A, B, and C structure. A being 75,000 minimum, B being 250 minimum. And then I think in this case, it wasn't $1 million, it was $500,000 to get the better return.
Was there any preferred return in there?
No, we didn't offer a preferred return. About 75% of our investors on every transaction are repeat, and they love the fact that we deliver what we say we're gonna deliver.
Okay. And then walk us through, how did you structure the fees on this deal?
So we did have an acquisitions fee, 1.5% acquisitions fee, and that helps us compensate our team. We've got 8 people in our acquisitions team, so that really does help compensate them for their work on this. We do have a property management fee of 3%. But that fee would be paid to anybody managing the property. It just so happens that we manage it in-house. We do not have a disposition fee at all, so there's 0 for that. And that's it on the fee side.
Okay, so no asset management fee or...
Oh, I'm sorry. Yes, asset
construction fee?
management fee. Yeah, 1.5% asset management fee.
And then since you are doing rehab on this property, did you have a construction fee?
We have a construction management fee. It ranges from 5 to 10%, depends on the expenditures.
Okay.
And we do put all of that into our underwriting, and we spell out all of that in the data we present to our investors.
Awesome. Awesome. Well, let's talk about the GP side of things. On this particular deal, especially since you had 2 deals running at once, not portfolioed up into that package, how did you structure the general partnership? Were you the sole capital, source for this?
Actually, we brought in a few other folks to the team that we've worked with in the past to do this one. And so we had a husband and wife, and then we had 2 other friends that came in to help on the raise. We have the bulk of it, and then they have smaller pieces of that. And then they are involved in communicating with investors that they bring in terms of performance. We do regular webinars with them so they can also present the data and share with investors what's happening at the properties.
Awesome. And how do you, and feel free to share what you feel comfortable sharing, but how do you generally structure that relationship with other co-GPs that are coming in on a deal?
Well, we do everything. First of all, I'll say our marketing team puts all the marketing pieces together to kind of share the information on the deal. We have an investment relations team that really does all the paperwork for investors, subscription documents, sending out PPMs, all of that. So there's little really for them to do except help market and then share information on how the deal is performing. So typically, we come in and say, okay, we will give you X% of the GP. And I don't really want to go into specifics on all of that because it changes deal by deal. But we share a piece of our sponsor compensation. So it doesn't affect investors.
Okay. Awesome. Yeah, because it's just, so many different types of listeners listen to this podcast. People that are just getting into the space, seasoned investors. And the reason why I like asking that question and how people, work with their JV partners or the other general partners in the deal is so they can get an understanding that there's so many different ways to put the pie together, essentially. Like there's not.
Yeah, there are. And, for us, I think some of the things people may want to consider are they being asked to sign on the loan? If they're being asked to guarantee, then they should probably expect a little bit more compensation. Are they being asked to put up the risk capital, which is the down payment, the escrow deposit on the front end? If they're participating in that, then I think they should ask for a little bit more because their money's at risk. In our case, we put up all the risk money and we're the only signers on the loan. So we're not asking them to do any piece of that.
Those are great tips there. Thank you for sharing.
You're welcome.
All right. So tell us a little bit about takeover. When you took over this property in September, were there any surprises in the first couple of weeks?
No. And because we do the diligence ourselves and we prepare for takeover 8 weeks before closing, our teams with the management side and our equity side are on calls every Friday. And they're going through a checklist, a takeover checklist. Everybody's assigned pieces of it. And so by the time we get to closing, everybody's been hired. They've usually been trained for a couple of weeks at one of our other properties. When we show up for takeover day, all the marketing materials are produced and ready. The employees, all their uniforms are ready to go and are delivered on that day to them. The signage, if we're rebranding, our signs go up the day we take over. The website is done and the software is loaded and ready to go. So it's important for us to have everything ready in the beginning because we know the momentum is the greatest on takeover. And in addition, the residential side of the house meets with the capital projects manager to understand how many units are being done, what specifically is going to each of the units. On the exterior, what is going to be done, who are the vendors selected to do that work, so that everybody kind of sees the vision for that property on day one and can execute much faster.
Awesome. Well, thank you for sharing that. In wrapping up, what did you find that was easy on this deal that actually turned out to be a little bit more challenging than you thought? And then conversely, what did you think was going to be challenging that actually turned out to be a little bit easier than you thought?
Well, I think one of the things was, really figuring out the rehab. That was one of the pieces we weren't too sure about because the seller had already done so much to the property and had not capitalized on those rents, right? And so for us, it was, do we add to their renovation package or is it good as is and just market the additional items and get the rents for them? So that was one of the things that I think we had to really think through because we're used to coming in and everything's got to be changed, right? Countertops and you name it. In this case, they'd already done half of the units. And so the decision was, you repeat what they've done or do you try a different approach to that? So that was one of the things that probably took a little more work than we're typically used to spending on an acquisition. And something that went, I guess, better than we expected was the fact that, we weren't sure what would happen with occupancy. They had a little bit of delinquency on their financials, not a lot, but we didn't know what was going to happen in between, the time you sign a contract and the time you close. But we kept tabs on all of that data very, very closely. And so we were pleasantly surprised that when we took over, there was nobody to evict. Everybody was good and they'd paid on time.
Awesome. Yeah, because that's always a very interesting transition time to see if the current owner is going to take their foot off the pedal a little bit, right?
Right. Well, we built in some performance measures into the purchase contract. And we said, when we bought this property, occupancy was X% and the income was at this number. There was a 5% leeway because if it varied more than 5%, then it would affect our loan proceeds. And so we built that into the contract, and it just added extra incentive for them to continue to keep their foot on that gas pedal.
Awesome. Well, Arleen, thank you so much for being with us today and sharing your insights and experience. If people want to find out more about you and REAP, how can they do so?
One great way is to email us at invest@reapequity.com, and that's REEP equity.com. Or you can also just go on to our website and click on the area for more information. Put your data in there, and we'll get somebody to respond to you right away.
Awesome. Well, again, Arleen, thank you so much for your time. We look forward to hearing about future deals.
That sounds wonderful. Thank you, Whitney.